I don't think there's been any particular problem with the numbers which have been delivered, as you say, and I think this is true both for in Europe and in the States. It's just the fact that in a way it's maybe the old expression "it's better to travel than arrive" is quite true at the moment. So as it were, technology stocks obviously have done very well, and as it were, share prices have gone up in anticipation of this. So when the actual results come out, even if they are somewhat better than expected, you don't get the typical sort of share price rise that you'd normally have seen.
So what is the issue here? Does this mean that actually the shares are overvalued, or actually what seems to be the case over the last couple of years is the fact it's just an opportunity to recharge for those who want to get longer?
I think some of it is that, as in the States, we've had a sort of blowout quarter this quarter in terms of the extent to which earnings have beat expectations. And again, in Europe, you're seeing the same kind of thing. But, this comes hard on the heels of the previous two quarters when also earnings beat expectations significantly. So it's maybe a bit of a contradiction to say, but almost the market was expecting earnings to beat expectations significantly anyway. So it's already in the price. So, definitely, I think you have to sort of continue with this value rotation, which has been sort of, there's been stops and starts over the last sort of month or so. But basically, what you're now seeing is that earnings are picking up rapidly. And that is going to, we think, support a further rotation away from the winners of last year towards the laggards of last year.
Yeah, absolutely, Rupert. And actually, the so-called whisper number you're referring to there, rather than the expected guidance across the board. Look, if you don't mind, I'm just going to interrupt this interview for a moment because I'm hoping now, actually, that I can see some Spanish data. But at the moment, it doesn't seem to be on my screen. I don't know if any of the producers... In fact, I have it. Thank goodness for that. I can rely on the Spanish, despite the fact that, of course, a big political ructions in Madrid overnight as well. So, Rupert, the April services PMI IHS market data out of Spain, and we've got it across the world today, including the United States, has come in at 54.6 compared with 48.1 in March as well. So a very solid services sector expansion figure out of Spain so far. Rupert, we're all data watchers. We always have been in market world as well. But I kind of can't help thinking that actually some of the established outcomes, apparently according to Mr. Powell, rather than the outlook, is the way forward. So do we have to change which data we focus on to see whether there's further fuel in this rally?
I think the purchasing manager indices, which you've just been referring to, they are somewhat problematic at the moment because they are just measuring business optimism rather than concrete data. And the problem is, in the States and indeed sort of increasingly in the UK and Europe, you're at sort of 10-year highs for some of these things. And yet, as it were, particularly in the UK and Europe, the economies are still well below where they were sort of pre-pandemic. So I think definitely the confidence numbers you have to treat with a bit of caution. All they're showing at the moment is that things are getting better very rapidly. So I think you do have to focus more on the hard numbers, which, as you say, is what the Fed is going to be doing.
So, Rupert, where's the opportunity at the moment? What are your clients looking at? What are they interested in? What advice are you giving them about entering new positions?
Essentially, in terms of whether you should be entering the market at all, our view is that, in a way, short-term markets have probably come too far too fast. We are overdue a correction. It looked like yesterday maybe we were on track for sort of a correction. Today it looks somewhat less likely. But the fact of the matter is, normally you typically see pullbacks of up to 5%, 3 times or so a year. We haven't had one for 6 months. So certainly a sort of small correction or a pause is definitely overdue. So I wouldn't be rushing in at the moment. But having said that, if you look sort of on a 6 to 12 month horizon, even though sort of sentiment indicators are fairly stretched on some measures, the sort of economic backdrop, as we're all well aware of, is sort of pretty positive still. And what that typically means is even if sentiment is stretched, you're not going to get a big fall back in the markets. You may get a temporary correction. And if anything, you should be using it to sort of put more money to work.